This is more than a story of Warren Buffett. It's a lesson of patience, long-term thinking, and proof that ordinary decisions, repeated consistently, can produce extraordinary results.
Omaha, 1930. The Great Depression choked the life out of the national economy, but inside one modest home, 6-year-old Warren saw something different. Where others saw a standard 6-pack of Coca-Cola, he saw a fragmented opportunity. He purchased the pack for 25 cents. He did not drink them. He carried them to the porch, separated the bottles, and sold them individually for 5 cents apiece. He watched the nickel pile grow. Each transaction was a physical proof of a hidden margin. He felt the cold glass in his hands, listened to the metallic clink of coins hitting his palm, and calculated the gain. The world outside remained bleak. Lines stretched around soup kitchens, and money vanished from bank accounts. Yet, on his small table, the stack of nickels rose. He learned the rhythm of trade before he learned the rules of school. He was not just selling a beverage. He was building a system where every cent had a purpose. By the time the last bottle was gone, the math was clear. He had turned a quarter into 30 cents, and in that small, quiet profit, a lifetime of compounding began. By 11, the focus shifted from physical bottles to the abstract speed of the ticker tape. Warren bought 3 shares of City's Service Preferred. He watched the numbers scroll, his pulse matching the rhythm of the machine. The price ticked up. A few dollars of profit blinked into existence. He acted, he sold, he held the cash, satisfied with the immediate return. Moments later, he looked back at the tape. The price was climbing again, higher, and then higher still. The gap between what he had taken and what he could have had widened with every passing second. He sat in total silence, the room feeling suddenly small, watching the potential profit evaporate into the air. He did not move. He did not speak. The realization settled in his chest like a lead weight. He had been fast, but he had been wrong. That afternoon, the market stripped away his arrogance. He learned that the ticker tape did not care about his urgency. It rewarded those who could sit through the noise. Patience was no longer just a word. It was the silent partner of wealth, and he had just paid a high price to understand its necessity. The lesson of patience did not lead to idleness. It ignited a relentless, grinding industry. Warren became a ghost in the pre-dawn hours. Before the sun touched the horizon, he was already on his route, tossing newspapers onto porches while the city slept. The work was repetitive, cold, and physical, but every paper delivered was a small, guaranteed victory. He didn't stop there. He scouted local barber shops and installed pinball machines, turning empty corners into revenue streams. He spent his afternoons wrestling with the internal mechanisms of those machines, clearing jammed levers and collecting the heavy, metallic harvest of coins. While others played, he counted. By 14, he was already navigating the formal world, meticulously filing his first tax return. He treated every cent like a seed, burying it in savings rather than spending it on fleeting distractions. The years blurred into a cycle of constant, calculated output. By the time he walked across the stage at his high school graduation, he had accumulated $5,000. It was a fortune for a boy his age, a mountain of capital built on early mornings, stubborn maintenance, and the refusal to trade his future for a moment of comfort. The rejection letter from Harvard arrived in the mail, final and cold. It should have been a wall, but it became a door. Warren turned his sights to Columbia, seeking something he could not find in Omaha. He walked into a classroom and found Professor Benjamin Graham. The older man did not speak in riddles. he drew a line in the sand. He taught that the market was a manic creature, a beast driven by the shifting tides of human fear and greed. But value was a cold, hard fact. It was a rock in a storm. Warren sat in the front row, his pen scratching against his notepad, absorbing the logic that would define his life. He watched Professor Benjamin Graham dismantle the noise of the ticker tape with simple arithmetic. The student became a shadow, offering to work for the master for free. Driven by a hunger that went beyond mere currency, he was turned away, then hired, then tested. In those halls, the boy who once sold individual sodas learned to see the world not as a game of luck, but as a map of measurable truths. He left Columbia with more than a degree. He left with a foundation that would never crack. The lessons of the classroom demanded a proving ground. In 1956, Warren returned to Omaha with a singular objective. He gathered friends and family, laying out his strategy on dining room tables. They brought their savings, trusting his vision with their futures. He took that initial $100 and poured it into his first partnership. The stakes shifted instantly. This was no longer just his own money. It was the security of the people who sat across from him at dinner. He worked with a new, quiet intensity, analyzing balance sheets until his eyes burned. The early years were a relentless engine of growth. He ignored the frantic pace of the broader market, focusing instead on the steady arithmetic of compounding. He hit 30% returns year after year for over a decade. The numbers climbed, confirming the logic he had studied under Professor Benjamin Graham. He built a reputation for consistency that drew more capital, more responsibility, and more scrutiny. By the late 60s, the modest partnership had ballooned into a formidable force. He had moved beyond being a simple investor. He was now a manager of significant wealth. He stood at the edge of his greatest leap yet, ready to trade the role of a passive observer for the power of a corporate owner. The partnership was strong, but Warren wanted more than pieces of companies. He wanted control. He set his sights on Berkshire Hathaway, a textile mill in New England that was bleeding money. To any other investor, the mill was a sinking ship. To Warren, it was a vessel. He began buying shares, quietly accumulating a position while the company struggled to keep its looms running. The business was dying, but the corporate structure was perfectly positioned to house his growing empire. He took the helm, and the transformation began. He did not try to save the textile machines. He let them rust. Instead, he stripped the core, turning the company into a holding entity for his investments. The name remained, but the identity shifted entirely. It was a cold, calculated move. He took a potential disaster and forged it into a permanent platform for global dominance. The mill was dead, but Berkshire Hathaway was born, becoming the engine that would carry his capital into the future. He had successfully turned a failing relic into the ultimate tool for his long-term strategy, proving that value could be found even in the wreckage of a dying industry. The textile mill provided a platform, but it lacked the fuel for the scale Warren envisioned. He needed a constant, massive stream of capital that did not require borrowing from banks. In 1967, he found the answer in national indemnity. When he bought the insurance firm, he did not just acquire a company. He unlocked a hidden mechanism. He realized that insurance premiums were collected long before any claims were paid. This was the float. It was money that belonged to the policyholders but sat in his control, waiting in the coffers. He could invest this money, reap the profits, and keep the gains while the premiums remained as a liability on his books. It was a perpetual motion machine of finance. He no longer had to wait for dividends or sell his winners to fund his next move. The float provided an endless supply of dry powder, allowing him to strike at major companies without hesitation. He shifted his focus from mere stock picking to the accumulation of this permanent capital base. With the float flowing into Berkshire, his investment capability hit a new, unstoppable velocity. He had moved from a gardener of his own savings to a titan of industrial capital, wielding the insurance industry to reshape the market to his will. The strategy was working, but it had a limit. Warren kept hunting for cigar butts companies that were cheap, failing, and barely worth the price. He was buying a dollar bill for 50 cents.
But the company was still a dollar bill that would eventually disintegrate. Then came Charlie Munger. He walked into the room and tore down the logic. "Forget cheap," Munger argued.
Buy a great company at a fair price instead of a fair company at a great price. It was a brutal correction to Warren's entire methodology. Warren hesitated, staring at the ticker, then realized the truth of the argument. He stopped looking for the bargain bin. He set his sights on the giant's businesses with deep moats, brand loyalty, and pricing power. He bought into Coca-Cola, watching the dividends compound while the company grew across the globe. The wealth did not just tick up, it exploded.
By abandoning the search for mediocre companies at bargain prices, he unlocked a new tier of growth.
He moved from a scavenger of market errors to a partner in world-class enterprise. It was the most important pivot of his career, cementing his reputation as a visionary who knew that quality was the only true hedge against time. The market began to roar. Then it began to scream. Tech stocks climbed to impossible heights, and the world convinced itself that the old rules no longer applied. Analysts filled the airwaves with predictions of a new era, calling anyone who stood aside a dinosaur. Warren watched the screens from his home in Omaha, the same house he had occupied for decades. He saw the mania for what it was, a collective delusion. While the herd scrambled to buy companies with no profits, Warren turned the page of his book and waited. He did not touch the tech stocks. He did not chase the momentum. He sat at his simple desk, ate his burger, and sipped his daily cola, entirely unmoved by the frantic energy of Wall Street. When the bubble finally burst, the fortunes of the speculators evaporated in days. The panic was absolute, but Warren was not among the panicked. He had not lost a dollar because he had never entered their game. By refusing to follow the crowd, he did more than protect his capital. He proved that true integrity is the ability to remain still when everyone else is running. He stood as a silent, immovable anchor, waiting for the storm to exhaust itself. At 90, the ticker tape had long since faded into a quiet routine. Warren walked into his office, the same steady pace he had maintained for decades. He reached for his pen, not to buy a share, but to sign the giving pledge. With that single stroke, he committed 99% of his life's work to the world. It was not a departure from his strategy. It was the final, inevitable yield of his harvest. He had spent a lifetime proving that wealth is not a sprint, but a long-term cultivation. He never split his stock. He never chased the short-term win, and he never let his principles bend to the pressure of the moment. He remained a gardener of capital, tending to his investments with the same patience he had shown as a boy selling sodas on a porch. He showed that you do not need to be the fastest to win, nor the loudest to be heard. You only need to be the most patient. As he closed his desk, the lesson remained. Time is the greatest asset of all, and the harvest is worth the wait. The cycle was complete. The seeds he planted in 1930 had finally, fully bloomed.
Thank you for watching WonderMind Learning. where curiosity grows into wisdom.